Megan, can the Fed walk and chew gum at the same time here?
So I think for now that they can. The Fed and every other central bank would like to think that they have very distinct tools for price stability and then other tools for financial stability. And so the price stability tools include rate moves, the balance sheet. And so the Fed hopes that they can continue to hike rates while also supporting the financial system through their tools for financial stability, which includes macro-pru, regulation, supervision. The thing is, the two get blurred at a certain point because financial stability weighs on macro stability and therefore price stability. I don't think we're really quite there yet, though. There's no doubt that the recent bank instability that we've seen will weigh on growth, but it's too hard to figure out this early on how big the impact will be, how much credit will slow, how much confidence will really be hit by what we've seen over the past couple of weeks. I suspect the confidence channel actually might be temporary, but we do know that credit will slow, and that should, on the margin, be a drag on growth. I just don't think it will be a massive one.
So it's so interesting you brought up the confidence, because you got the March consumer confidence number. It was really strong. Like, expectations really strong, present situation really strong, and that encapsulates sort of the tail end of the banking crisis over the last couple weeks.
Yeah, I wouldn't read too much into just one figure, but it was strong for March after pretty weak figures for January and February. So it just suggests that, consumers didn't go hide under, a blanket in the face of this bank instability. There wasn't that knee-jerk reaction. And also, we don't know how long this bank instability will last, how much it will spread. We're really just at the beginning of this, and I think it will be a process that's going to play out over the course of months, not days or weeks. And so consumer confidence might continue to be hit, but for right now, it seems to be holding up pretty well.
When you talk about we don't know, I think a lot of people look to the bond market for those signals. They're supposed to be the smartest people in the room, and we're not getting clear signals from the bond market. If you look at Fed pricing, it's all over the place. Have you ever seen such confusion about what the path forward might look like?
So I haven't seen so much confusion in terms of market pricing for the Fed path, but I also haven't seen such contradictory data coming out of the economy either. There is data to tell whatever story you want to tell right now in terms of the U.S. economy. And monetary policy isn't really feeding through as we expect it to. It's working through financial channels just fine. So it's working through the banking sector, but it's not working through the real economy, and particularly the labor market, as we're used to it to. The labor market's held up freakishly well, really, given the aggressive rate hikes that we've seen. Part of that might be because of the pandemic, the labor supply is smaller. Part of it might be labor hoarding that we're not really used to. We don't know how to measure any of those things, though, so it's difficult to anticipate how the economy will respond, how inflation will respond, and therefore how the Fed is going to move. But I think that the Fed is going to continue to use rate moves to lean against inflation, even if we have further bank instability, and is going to use regulation and supervision to try to support financial services.
And so investors seem to be on high alert as to, well, what is that going to mean in terms of what's the Fed going to break? So if they successfully kind of ring fence the regional bank issues, I've seen a lot of people get increasingly concerned about areas like commercial real estate, and that's where we're going to see perhaps more cracks start to emerge. Have you thought about that as an area to keep a key focus on?
Yeah, so I do think there are some concerns around commercial real estate, particularly given the work from home trend post-pandemic that we have. Although, that's mostly hitting big cities like New York and San Francisco. And I think most commercial real estate loans could be originated from the bigger banks in those two cities in particular. So in general, most commercial real estate loans are coming from smaller lenders. But where commercial real estate is going to be hit the hardest, there's bigger banks are playing a bigger role. And so that suggests that we don't need to worry quite as much about commercial real estate as some are arguing. But it's a concern also if we assume that there's going to be more regulation for smaller banks, and I think that's a safe assumption. What we know from the global financial crisis is that banks wanted to show how responsible they were, and so anticipating regulation coming down the pike, they went ahead and implemented it up front. I think smaller banks are going to do that this time around as well. So that will, of course, slow credit growth will cause banks to shrink their balance sheets. So even before we get regulatory changes, I think we'll see an impact on how smaller banks are operating.
So a hard landing or a soft landing is more or less likely? What do you think then?
Yeah, so I have been arguing that we'll go into recession before this financial instability. Now I feel more strongly about it. I still think that there's a chance that it will be a short and shallow recession. But if we get a financial crisis on top of it that the central bank can't paper over, then that would be a longer, deeper recession. And that could happen if things, if asset classes that the Fed's not willing to buy get into trouble. And there I'd say corporate credit is a concern. I mean, about a third of our corporate credit is BBB rated. If that gets downrated into junk, the Fed can't step in to buy that up. So there are some asset classes where the Fed actually can't step in to paper over it, like it was able to with the financial instability we've seen in recent weeks. And the Bank of England last autumn, I think, is a good example as well. Central banks can't do that for all asset classes.
Yeah.
And as regulation increases for banks, of course, more activity is going to move out of banking into shadow banking. So there could be surprises lurking for us there.